Right. Good morning. Welcome. You're watching BQ Prime. I am Harsh Saita. We're going to talk to the management of Veranda Learning. In fact, the stock was up 20% yesterday, down around 2%, 1.5% in early trade today. Of course, disclosed earnings, but that solid rally of 20% yesterday showing some promise with regard to returns to shareholders. Let's quickly take it to the management without much delay. We have with us Suresh Kalpathi, who is the ED at Veranda Learning Solutions. Good morning, sir. Welcome to BQ Prime.
Good morning.
Right. Let me quickly take it to you with regard to top line growth. Top line growth has been stellar off a low base. You're expecting to double revenue this year versus last year from 200 crore. Just to give perspective, go to 400 crore this year. What are the levers which are, giving you that confidence that you will double up on revenue again in FY24 as well as your guidance for FY25 as well?
I think first is Veranda Learning is a platform that's being built on acquisitions. So there were a few key acquisitions that was completed in the last financial year. The integration and enablement and the empowerment of those acquisitions is really what is driving the change this year. So these are the results of the acquisitions we did last year that's driving this significant growth. The confidence of achieving a 400 crore top line this year. We started Q1 at about 70 crores of revenue. Q2, the quarter that we just declared, we had a run rate of 100 crores for the quarter. So we are clearly on a momentum to comfortably reach our 400 crore revenue target that we have given for FY24. There are a set of acquisitions that got completed this year. We are targeting to see if we can close a few more before the end of this financial year, March 24. And that is expected to trigger and fuel the growth for FY25. While the acquisitions we have already completed will significantly add to our top line and bottom line, the acquisitions we did in FY23 will continue to be on a steady state of growth. So far we have done about 11 acquisitions, and that is really triggering the growth this year and the next year.
Right. Before I move on to acquisitions and to try and break acquisitions down, the strategy down on that count, let me also try and understand digital versus physical, right? You've acquired the likes of a JK Shah classes. You also have plenty of digital platforms that you run. Currently, my understanding is around 30-70 is the ratio with regard to revenue, digital versus physical. How will it evolve as revenue doubles up both in FY24 as well as in FY25? My objective here is to try and help break down how scale will impact margins, because digital will obviously be more margin accretive, right?
I think the first is both are very synergistic. And just to give a perspective, in FY24, 22, our entire revenue was online. This was deep in the time of when the COVID was on rampage. FY23, we were moving into a ratio of about 25-75. This year, we expect it to be about 30-70 between online and offline education. And we expect that to sort of continue as the new normal. Obviously, the margins on both the lines of businesses depend on one fundamental common factor, which is the quality of your content, quality of pedagogy that you have, the testimonials of the brand that you are building out, and the quality of the outcomes. And independent of whether it is online or offline, these are the factors that really drives revenue and your pricing power. So given that most of the acquisitions that we have done are of businesses which have two key factors, which is profit and pedigree, it is enabling us to drive both the lines of revenue as profitably as the other one. So it's not as though we make money in one and we are using that to build out. Both of them are running at about similar profitability. Some of the lines of businesses we have, especially the physical format of the business, do have some franchising operations where we work with partners to keep the model asset light. And those businesses have margins that are based on the franchising we charge. So typically this year, for instance, we expect our margins to be anywhere between 17 to 18% for this year. Going forward, we think we should be able to have a steady state margin of between 24 and 25%. This is at the EBITDA level.
Right. Understood. Point taken. Let me quickly move on with regard to acquisitions. We've spoken about how it's going to be the key with regard to growth. Acquisitions is going to hold the key. Now, in the past, we've seen several companies focus on acquisitions for growth. What is different that Veranda Learning is doing? What is the kind of ticket size that you're looking at in terms of acquisitions, and what are the factors that you look for when you're looking to acquire another company?
So first is we are at Veranda trying to, sort of what I call as fill in the grid of the Veranda ecosystem. So that sort of we want to ensure that it goes all the way from the early learning years of a child to their education through college to post-college upskilling. So we really want to be part of the learning life cycle of a person from end to end. That's the broad agenda. And to that extent, the acquisition of assets are in areas which helps us fill up the grid. My guess is we are about 65-70% there in filling up the grid in many of the areas which somebody would typically go through in their learning life cycle. Couple of factors that we look for in any of the acquisition, as I just mentioned, are profit and pedigree. So pedigree is really, for instance, to give the example of a JK Shah, it's a 40-year-old brand. The one that we work with in Andhra, Telangana for state central government exams is over 20-year-old brand. So most of these brands have decades of background of having delivered very high quality education and high quality results. And those are critical. Now, coming to the third key point, acquisition as a strategy has always been around, be it in education, it's been there in many of the other fields. And acquisitions don't create value. Because all you need to complete acquisitions is really a lot of money. And if you don't have a great equation with the sellers and you go hostile, you probably need a whole lot of money. But that doesn't really create value. The value gets created in your ability to integrate, empower, and enable the former promoters to continue to build it very strongly, but with the power and backing of Veranda. So again, examples, when we acquired what we today have rechristened as Veranda Race, the business was losing money and we were doing about 70-80 lakhs. This was in somewhere around December of 2020 after the acquisition. Today, we expect Veranda Race to deliver a top line of over 100 crores for FY24. So that creates value. If you take an example, for instance, of a JK Shah, from a profitability of about 20 crores in 23, when we completed the acquisition, we expect FY24 for JK Shah to be profitable to the extent of between 40 to 45 crores. So that doubling of profitability that you are able to enable through your strategy of integration and empowerment, that creates value. So the strategy of acquisition has been around for a whole lot of time. It needs very little except some connect with solid investment bankers and a whole lot of money. But the value for the investors get created on your ability to integrate, empower, and enable those assets.
Understood. And what's the acquisition pipeline like? What's the target for FY24 with regard to size, and how are you going to fund it?
Well, we continue to discuss with people. So it's too early for me to sort of conjecture as to what would work, what wouldn't work. But there are gaps in the grid that we are trying to fill. And as far as it fits the criteria of profit and pedigree, we will continue to engage in conversations. There are many conversations that are ongoing. Size has really not stopped us from doing an acquisition. As far as we think it's worth it, and it will be something that we can significantly grow after we get into their cap table. In terms of financing these assets, we clearly want to ensure we do it with convertible, with a certain level of leverage. And we want to ensure our leverage stays between 1.7 to 1.8 times of EBITDA, just to ensure we don't get over leveraged. And at the same time, the rest of the money we hope to raise through convertible instruments so that we are not diluting, our equity at this point in time. We think uh, the value is only getting unlocked. So we really don't want to do an equity raise at this point where we think we probably have not realized the true potential of the business we are building.
Right. And if I understand correctly, the strategy is to hold the current set of promoters of the acquired entity still within the business, still within the company to continue to run the company, right? What motivations do you all lever upon to try and make sure that they are giving their 100% and they are going to try and deliver for you? And what's the kind of value that Veranda adds to them that keeps them motivated to try and allow a buyout?
So I think the first is that we don't do 100%. We do anywhere between 51 to 76%. So the balance equity stays with the sellers. Uh, Typically, the sellers will exit that between the third and the fifth year after we complete the initial buyout. Uh, so that sort of gives them a motivation from a perspective of creating additional wealth, which in some cases does work. But my view is that for people who have built significant businesses and significant brands, especially in this country, uh, and again, just to sort of restate, most of the businesses we have acquired are businesses built by first-time entrepreneurs. Uh, and take it from me, as a first-time entrepreneur, I can tell you that the first significant business that you build becomes sort of part of your life. You're really are very proud. You really are attached. You are recognized, known for what you have built. Beyond a point, wealth does not become a very significant motivation. It is that ability to continue to travel with the business they have built, see it really flourish and grow, and knowing that they've given it in the hands of somebody who can hold it to posterity. I think that's really what motivates uh, serious sellers who have built businesses with pedigree. This goes for almost all the businesses we have acquired. The sellers of those businesses, all of them are still part of the Veranda ecosystem, and they're all part of our team Veranda.
Right, understood. I'll shift focus back to profitability. You spoke about an EBITDA of roughly 17% in this year, 17-18% margin. Looking at the way in which the numbers are lining up, probably on a 400 crore of top line, you'll make 68 crore of EBITDA, which was negative last year. So that should ensure that there's some amount of cash flow coming. Next year, though, you're expecting EBITDA of around 200 crore because that'll take your margins to 25% thereabouts. Is that the correct way to look at it? Also, where should that leave profit after tax? So you will start being profitable full year from FY24 itself. Is that the way to look at it?
Well, I think from an EBITDA perspective, as I said, there are many ongoing conversations that we are having, and it's tough for us to project and predict which one goes through, which one does not get completed in its full form. Uh, but yes, we expect our revenues to significantly grow. I'm just putting a caveat saying it is subject to a couple of acquisitions that we are targeting to close. Uh, but even without that, I think our margins will continue to move up to the range of 24-25%. And of course, we expect our top line to significantly grow based on the businesses we already have, independent of new acquisitions happening or not happening. At a PAT level, there is, quite a bit of acquisitions that we have done. So obviously, there is a write down of some of the provisions into our balance sheet, whether it is in terms of technology, it is in terms of non-compete, and some of the others. Uh, but we expect most of them to be overcome by the EBITDA that we will have this year. So, we are working hard to see if it can become PAT positive this year. I'm not so sure, but FY25 will be a significantly PAT positive year, apart from just being at the EBITDA level.
Right. And you'll continue to acquire even FY25 onwards, or will acquisition stop at FY24?
I think most of our significant acquisitions will get completed, as I mentioned, during this financial year ended March 24. unless there is something very, very strategic and extremely significant, we don't see ourselves going on the momentum of acquisitions that we have done for the last 2 years. And again, if we get to complete the ones that we are currently targeting, most of the acquisitions, if at all we do some, we will continue to do smaller tuck-ins, will all be based on internal cash flows and a bit of a leverage. There would not be an equity dilution for those.
Understood, understood. And to try and understand what kind of issues one would face in a business like this, would supply issues at all from a teacher standpoint, from a professor standpoint, given that 70% of your mix will continue to be physical, do you see that as a challenge?
I think it is. For some of our lines of businesses, it is a pretty significant challenge because there is not so much a dearth of teachers. I think it is more a question of having supply constraints of quality teachers. Some of the ways we are doing to overcome that is obviously have stock option plans to retain the people that we already have, who have gained the experience of the pedagogy that we use to deliver our education. And the second one, of course, is to do a lot of internal training. I know some of our business units have a very stringent criteria for taking teachers on board, and they go through a very significant training under the eye of the promoter themselves before they allow them to enter their ecosystem and deliver program under their brand names. So yes, there is a constraint, supply constraint in terms of quality teachers. So most of that is being overcome by a significant amount of internal training.
Right. I know I overextended my stay, but my last question will be with regard to competition and consolidation within the industry. What are the kind of trends that are shaping up from an industry perspective? You compete with the likes of both the traditional, trainers, the likes of a Teamlease and the like, and the more modern ones, which is the larger ed tech platforms that are really in vogue since COVID. How are you looking at trends within the industry, and how are you looking at competition, pricing, and the like?
I will, state something that I've always stated. Education has not changed over the last 100 years. It's remained the same. The technology and platforms that we use to deliver the education keeps changing. People used to learn sitting under a bodhi tree. People were after that learning under ashrams under the critical eye of a guru. People have been learning reading books. People have learned seeing TV. Now people are learning things, seeing things online. That is only the platform, the way you project and the way you deliver your education. Education always depends on the quality of outcomes that you deliver, and that will also drive your pricing power. And again, as I mentioned, this is what I call as pedigree, which is how many people have you trained, how many of them have achieved outcomes, how long have you done this, and have people found value in the outcomes that you have delivered. The mode of education, whether it is online or offline, I don't think differentiates companies, because today technology is almost used by everybody. Banks use technology, insurance companies use technology, some of the financial services guys use technology, and these are people like banks that have been around for 50, 60 years now have accommodated and used technology to provide their services even in a better way. So everybody uses technology. The sector that we are there is in education, and this space in India is so large that I don't think there is really competition. There is a space for everyone. The sizes are pretty significant, and it is continuing to grow at a very, very healthy pace. There is space, of course, only for people who deliver quality education. That's something that I underline, but there is space for more competition than what is already there today.
Right. Thank you so much, sir. It's been a pleasure interacting with you. Stock up 1% in trade today as well. After that 20% rally yesterday, we had with us Veranda Solutions, of course, the executive director there, chatting with us about on with regard largely to the company as well as the numbers and forward projections. Thank you so much for that, sir. It's been a pleasure interacting with you.